Welcome to our presentation. We're Team Gamma, and today we'll relate operations and supply chain management class concepts to a real-world example of supply chain financing at Corpay. Corpay is a corporate payments company that helps businesses and consumers pay expenses in a simple, controlled manner.
In a typical business transaction, there is usually a period between when a company receives payment from a customer for a good or service and when the company makes payment to their suppliers. This gap in cash flow can result in high costs associated with holding inventory, amongst other risks. The proposed solution that we'll be speaking about today is supply chain financing. Supply chain financing can help improve cash flow throughout the supply chain, reduce risks, and improve supplier-vendor relationships. As we dive in, let's discuss holding inventory. There are usually high costs of holding inventory, which is a substantial concern in operations and supply chain management. Inventory ties up capital that could otherwise be invested elsewhere, incurring carrying costs such as storage, insurance, and depreciation. Moreover, excess inventory increases the risk of obsolescence and spoilage, leading to potential write-offs and lost opportunities. Inefficient inventory management can also result in warehouse congestion, longer cycle times, and increased logistics expenses. To mitigate these costs, businesses must adopt strategies such as just-in-time inventory practices, advanced forecasting tools, and technology-driven solutions for accurate tracking and replenishment. By optimizing inventory levels and streamlining operations, companies can minimize the financial burden of holding inventory and enhance overall supply chain efficiency.
Luckily, there is a solution: supply chain financing. So, what is supply chain financing? It's a set of financial solutions that allow different players in the supply chain to manage how cash flows. This involves techniques like invoice factoring, which allows businesses to get money on outstanding invoices immediately, dynamic discounting, where payment terms are established between a buyer and supplier to accelerate payment for goods and services in return for discounts, and supply chain financing platforms, which are an emerging market of fintech-based solutions.
So, how does supply chain financing relate to operations and supply chain? Well, an efficient supply chain financing strategy is secure and predictable, which in turn helps ensure proper inventory levels for both buyers and suppliers. This allows both parties to optimize the inputs and outputs of their operations to best meet demand. A comprehensive supply chain financing strategy also reduces variability. As we know, variability in any process reduces efficiency of both the process and forecasting. Limiting variability in financing means that buyers can more accurately predict order sizes. This, in turn, means that suppliers can more accurately predict how much finished product inventory to produce. As you can see, well-planned and executed supply chain financing is essential to efficient operations, which is what this class is all about.
As Max mentioned, supply chain financing is beneficial to both buyers and suppliers as it helps them manage their cash flow by optimizing when payments are made in the supply chain. In traditional business cases, there's usually a gap between when a company receives payment from its customers and when the company pays its suppliers. However, this can cause issues when it comes to smaller suppliers who might not be able to afford the gap in payment. That's where supply chain financing comes in. So let's look at an example of how it actually works. So let's say company X, the buyer, orders products from their supplier Z. Normally, supplier Z would submit an invoice after shipping the goods, and company X would make a payment over the course of maybe 60 days. Supply chain finance is helpful in a case where supplier Z is in dire need of the cash and needs the payment immediately. In this scenario, company X could partner with a financial institution like Citibank to provide an early payment to its supplier. Although the money that Z receives from the bank is less than what company X would have originally paid with their purchase terms, supplier Z benefits from having immediate liquidity. This also benefits company X because they will now have an extended period of time to pay the bank without negatively impacting the suppliers. The bank benefits because they can charge company X a fee for providing the early payment to supplier Z, and they could also charge interest on the financing. Overall, supply chain financing benefits all parties involved by improving cash flow, reducing risk, and strengthening relationships within the supply chain.
When it comes to supply chain financing, there are several risks. Regulatory compliance risks and creditworthiness concerns are two big ones. If a company has too many violations and or is valued that it cannot pay off its debt and has a poor credit, they're unlikely to get financing at all or will be at the worst terms. This goes hand in hand with the cash flow problems with managing the supply chain. Also, if the market is volatile and labor or materials cost increases, that can disrupt the supply chain by slowing things down if the company does not have the cash to meet the new changes. Essentially, making sure the company is always compliant with regulatory standards, is able to handle their cash flow well, will keep their supply chain risk at a lower level.
Corpay is a provider of corporate payments, offering accounts payable automation, and is currently exploring offering supply chain financing to customers. This would essentially be a short-term loan to our customer, who would be the buyer in this transaction. The first step for us at Corpay would be to determine the creditworthiness of our customer. This helps us reduce our own risk of taking on the transaction. Next, the customer must agree to a percentage-based fee structure, much like interest on a loan. Once the customer submits a participating invoice, Corpay would then initiate the payment to their supplier on their behalf. Then, at the agreed upon time interval, Corpay would collect the original invoice amount plus our own fee from the customer. This solution can bring supply chain financing benefits to smaller companies that may not have established relationships with large banks.